to see my broker, find out what he can do, 'cause I'm in the market for you.
Welcome to Stock Talk Happy Hour, where we have casual conversations about stocks, the market, and trading with other traders. Hi everyone, and welcome to Stock Talk Happy Hour. Today's guest trader is Jarrid Johnston. Today we're going to mix things up a bit. Jarrid has been kind enough to agree to share his fundamental process that he uses to filter stocks for his watch list. Hey Jarrid, thanks for being on the show. It's great to have you here.
Hi Heather, thanks for having me. It's a real pleasure.
I didn't think we were ever going to get you on. You're so darn busy.
Yeah, seems to be how life goes these days.
Well, before we dive into your fundamental analysis, why don't you tell our listeners a little bit about yourself and what you do at the hedge fund that you work for?
Yeah, it really started back in high school. Fortunate enough, my dad at the time gave me a book called How to Make Money in Stocks. And here, being in high school, he wanted to get me interested in investing. And my journey really began in my later teen years. Through most of my life, pretty much investing from a fundamental basis has always been a hobby of mine. And then upon graduating from college, had the opportunity to eventually work my way into a equities hedge fund where I currently work now. Luckily enough, I've been able to work myself up to the senior research analyst role, where I work alongside our portfolio manager, conducting the daily due diligence of current holdings, in addition to running the process on finding new investment opportunities.
That's impressive. Not many teenagers are into fundamental analysis in high school. I think it's safe to say that when people invest, they pretty much follow one of three approaches. They're either enter a stock on technical analysis, or they're die-hard fundamental analysis, or perhaps every now and then you run into people who are a hybrid of the two, where they'll filter stocks for strong fundamentals, and then they'll wait for the technical setup and the breakout or the breakdown before they enter long or short.
Me personally, I consider myself more the hybrid type. I do lean a lot on the fundamentals, and what I've come to learn over the years is that while knowing your technical analysis is important and very, very useful for your entry, exit, and trade management strategies, the reason the stock is moving is usually due to some fundamental catalyst that is going on with the company itself. So honing those fundamental skills enhances the technical ability.
I couldn't agree more.
I get a lot of questions about, why do fundamentals even matter anymore? It seems like the buzzwords you hear these days are high frequency trading and algorithm trading. And so while that may be true to some extent, fundamentals will forever, in my opinion, remain an important concept of investing. And a few things that I always point to is one, fundamental analysis uses actual information about a business. You're looking at the financial statements, you're looking at earnings call transcripts, you're listening to management that goes out to conferences, and using real information about that company to try and determine the true value of a company's stock price. Secondly, stocks that go on a long run, as Bill O'Neill has proven with the IBD system, is that those stocks that go on the long runs are driven usually by strong fundamental growth, and that's with respect to revenue growth and earnings growth. Another aspect I find important is that a lot of people forget that when you buy a share of a stock or shares of a stock, you're actually buying part of a business. You're not just buying a piece of paper or you've got some fake number in your brokerage account. You're actually now owning part of a business, and thus you should treat it as such, like you are now an owner of that business. Knowing the fundamentals should be of importance. Another thing that I also point to is, without knowing the fundamentals of a company, it's hard to know whether or not it's in good health. Is it a good company? Is it a bad company? Is it accelerating its growth? Is the growth decelerating? And if you don't know the health of the stock, then why would you invest in it? One way to prevent yourself from investing in bad businesses is by knowing the fundamentals.
Would you say that those who are investing in stocks with strong fundamentals have a longer time frame for their investment than perhaps those who use technical analysis?
I agree with that to some extent. Usually, those that are more focused on fundamentals do have longer time horizons. I myself use the fundamentals, and thus my time horizons are several months to a year if the story remains intact. It's definitely true in that the shorter term traders, your swing, your day traders, are more focused on the price action and volume more so than the fundamental story that's driving that. So when we're talking about fundamental analysis, what are fundamentals? And really, I just wanted to outline a few aspects that I feel are important when looking at a company's financials. And so it really revolves around the three main financial statements. You have your income statement, you have your balance sheet, and statement of cash flows. For most people, just focusing on income statement and balance sheet are sufficient. They'll give you more than you'll ever need in terms of information and analyzing. One thing to be mindful of with regards to the income statement is that's where you're going to see the operations of the business. So the top of it, you'll see your revenues. So that's the money the company's bringing in from selling their products or services. And then they're going to minus that incoming cash with the expenses it takes to run the business. At the bottom of it, you're left with your profits. When looking at the income statement, some key metrics that I like to pay attention to are your gross profit margin, your operating margin, and earnings per share, or what people refer to as EPS.
I think earnings per share and sales and definitely margin, those are the three big ones that I look at in addition to cash versus debt.
The other thing is that, it's not so much about what the absolute numbers are, it's more about where they came from and where they're going.
So more of a relative comparison than an absolute comparison.
Right. Those that spend a lot of time doing fundamental analysis is you realize that certain industries have certain metrics. Pharmaceutical industry, they have very high margins. It doesn't cost them a lot to make their drugs. They can sell it for pretty high prices, and so they have very high margins versus a semiconductor company that still has very good growth, but it costs a lot more to make a hardware chip, and thus their gross margins are a lot lower than pharmaceuticals. And comparing pharmaceuticals to semiconductors is one thing, but then when you're looking at that industry group amongst the peers in that group, you're definitely looking more on the relative basis.
Well, that makes perfect sense. It's apples to apples versus apples to oranges kind of comparison.
Exactly.
So would you say that in addition to researching individual stocks, then you also research the industry group as a whole?
Yes, I do. While most of my process is a bottoms-up approach, there are industry factors that will impact all businesses in that industry. And so it's very useful to try and understand the current market dynamics of that industry. And usually that could easily be found by Googling the industry of the stock you're looking for and just seeing what sort of news articles are out there and what is being talked about.
It's really impressive what you can get on Google and Yahoo. You can get all kinds of financial statement information and all kinds of news for free. I wanted to ask you before we continue, are most of the stocks that you hone in on growth stocks? What primarily do you like to focus on in this filtering process?
I really like to focus on the growth stocks. If you had to ask me what my core strategy is, it is definitely the can slim type strategy. So I am looking for companies that are growing its sales 10, 15, 20 plus percent, same sort of growth on the bottom line, but really just looking for strong businesses that have several catalysts that's going to carry their stock over the next year or so and has a defensible advantage against peers.
What are some of the ways that you determine that earnings per share, that EPS and sales stability?
The core of my fundamental process is really, it starts like most other strategies. I'm looking for the fundamentally strong companies. I'm usually finding those through screens on MarketSmith, articles, Wall Street Journal, Barron's. Luckily enough, through my current firm, I get access to sell side reports. So analysts that are following the public companies will put out reports. Through a variety of avenues, I'm able to find candidates that at the surface look very enticing. And so after I've identified a few, I'll then take it to the next step where I actually look at the fundamentals. So I go on a company's investor relations website or the SEC website, and I'll pull the recent financial statements and I'll look, is it in fact growing? Because sometimes, things can get embellished in news reports. Looking at the actual financial statements will confirm to you whether or not the fundamental profile is as strong as you initially thought. And after doing just a brief look over of that, determining that in fact it is a strong company, I'll then dive a little deeper. So the majority of my time is spent really on the third step, where I'm researching the company to understand a few things. I'm looking to understand the industry's health, growth durability for that company within the industry, growth catalysts over the next year or two, margin momentum. And so by that, I mean, where is the gross and operating margin now, and where is it expected to go moving forward? And then using all those to help me determine what the appropriate valuation of this type of company. A lot of times you hear forward price to earnings ratio. It's kind of the gold standard, but depending on the company and industry, there are other metrics that can be used, but usually most people will be looking at a forward PE ratio. And then lastly, another important factor is risk factors. So what are the potential threats to this business that could end up affecting the stock?
What's one of the ways that you research those threats?
Not only do I search the company I'm looking at specifically, I will also look at its peers. If you go on to a Google Finance or a Yahoo, there are sections there where it will show you peer groups. And so it'll give you a list of 5 or so other companies that are very similar to the one you're looking at. And so using those names, I then can look at what those companies are doing, and you start to kind of form your own consensus about what's going on in the industry and what's going on amongst the players in that industry, and really kind of understanding what are the key issues. With a semiconductor company, price is usually a big factor. And so who's the price leader? Who's winning all the business? Whoever's winning the new business, are they in fact the price leader, or are they now trying to undercut price? The customers are now responding to lower pricing versus higher pricing, and understanding those dynamics give you a better idea about risk factors.
So basically, it sounds like the first thing you look for is kind of the story of the stock, the story of the company. Then you go into the financial statements to verify if it's as great as they say it is. And then you dig a little deeper, going into some metrics that give you information on valuation. And then you do a risk assessment.
Exactly. And then from there, I then take all this information that I've gained, then try to project out what the company is going to earn for the next 2 years. And the way I go about doing that is to recreate the financial statements and use the historical information that's already happened to then project what the company might do. And I usually stick around a 2-year time horizon. Any further than that, you're really just guessing at that point. Most companies, really, you can model out to the next year or the next 2 years from that. Once I've created that financial model, I know what my target EPS is that I'm going to be using. And then from there, now I'm starting my valuation analysis. And the core of that is really using comparable analysis. And so that is using the peer group that I mentioned earlier to understand what the value of each of those companies within the group is, and from that group determining an average multiple that group trades at, and then understanding the relative performance of the stock that I'm looking at versus the rest of the peers. Is it trading at a discount to its peer group? Is it trading at a premium? If so, why is that the case? And then where do I feel there is a disconnect between what I'm seeing in the fundamental future of the business and what its valuation multiple it's being given to by the market. Once I've determined a fair multiple range for the stock that I feel is appropriate for that, I apply it to the 2-year EPS projection, and that gives me a price target that I try to follow. After that, we go to our trade plan, follow my buy and sell rules, using that price target as sort of my goalpost of profit.
That sounds like a very thorough process. And it also sounds like a two-part process where first you take the actual fundamental data to research the company, and then from there you go to projecting estimates about the fundamental data in the future.
Exactly. Usually I like 3 years of historical information. It gives you a pretty good trend of where things are going, and then from those 3 years of historicals, then you're able to project the future periods. Here's an example from this year that was a successful trade. So I'll just kind of walk you through my process, how I discovered it, my research about it, and then all the way through forecasting the company and then determining a price target. We can even get into sort of the buy and sell rules that I used. Sure, a lot of your listeners are going to be familiar with Gigamon, ticker symbol GIMO. It's been a very popular stock on IBD this year. I became aware of the name March of this year, and where I really found it is I like to follow the IBD electronic newsletters. So I'm always checking the website for articles, and sure enough, in March, you started to see Gigamon pop up in a lot of articles at the time. Here is just a screenshot of an article from March 16th saying top new issue, Gigamon continues sharp turnaround. Again, April 8th, another one, Gigamon gains force in battle against cybercrime. And also, over the last year, you heard a lot about cybercrime. Cybersecurity, the Palo Altos of the world, is a very hot topic right now. And a lot of investment is being put into that by businesses. And so as you listen to businesses talk about where they're spending their money, a lot of it is to protect themselves from such threats. It had always been an industry that I've kept track of, and then Gigamon seemed to be going through a turnaround that resulted in me wanting to take a further look at it. At the time, here in April 2016, you can see the top chart here is consensus estimates from 2014 projecting out to 2017. And I get these estimates from a product called Capital IQ. It's a paid subscription, but there are similar charts on Yahoo Finance that you can use. When I start my process and I find a company that looks interesting, I will plug it into my charts here and just kind of get a flavor of what's expected of the company. Where does it done the last year, and what is it expected to do the next 2 years? And so here you could see 2015, the first left box, revenue grew 41%. And it's expected to grow 25% in 16 and 18% in 17, which is very good, very strong, especially in this day and age. Having something growing over 20% is definitely a strong company.
Well, that doesn't strike you as a red flag that it's decelerating from year to year on the growth?
It is something to be aware of, but the reason that it doesn't withhold me from looking at this business is that oftentimes analysts' projections trail the actual performance of a company. And I show at the top row the average estimate. The middle row is the high estimate, so the highest analyst estimate, and then the lowest estimate. And you can see it's pretty broad range in terms of where analysts are projecting the growth. And so I question myself as to whether or not that deceleration is likely to occur or not. Now, sure, as a company becomes bigger, it's a law of large numbers, and the growth will continue to decelerate just by the nature of being such a large business. And you won't expect that growth rate to maintain. But really, if it's holding up there, or I feel that there's upside to the current estimates, then I will continue to spend the time to do the research.
Given what you said about the growth slowing down as a company gets bigger, do you like to primarily focus on small cap companies since they have more potential growth?
The first several years of a public company are usually the highest growth periods, and there's the biggest potential to see some really great price appreciation as that growth unfolds.
Do you limit the market cap on stocks that you'll research?
I do. I tend to stay above 500 million market cap. Once you start to get lower than that, sometimes liquidity can become an issue, and stock prices are easily manipulated given that low volume. So I like to stay above a $500 million market cap, or if we're looking at it on a daily traded dollar amount, looking for companies that are trading at least $5 million a day in terms of value.
So at least $5 million volume liquidity and at least 500 million on the market cap. Do you have an upper limit for the market cap as well as a lower limit?
No upper limit. If a mega cap company has the growth, I'll look at it and try and trade it if appropriate.
So when you're evaluating a stock, like we're looking at the Gigamon right now, is it more important to you to just see strong numbers relative to its peers as far as EPS and sales and margins, or is it more important to you to see accelerating EPS, sales, or margins?
In a perfect world, you'd love to have both. I think where it starts for me is I'm looking for a strong company on an absolute basis. And for me, a business growing over 20% in the current year is a strong company. The next level down is comparing that growth to its peers. And if it's at least in line or better to the growth of its peers, that just increases the confidence level. And then the third level that you look for is, yes, is the growth accelerating or is it decelerating, and understanding why it is going one way or the other. And that helps sort of frame it all out to give you sort of an overall confidence level about the strength of the business. So here, in addition to the consensus estimates that I show you below that, I also show you, and I like to track this in terms of doing my initial research, is the actual results versus the expectations for the last several quarters. Here I show you from first quarter of 2014 to the fourth quarter of 2015, what the company did versus expectations for both the top box being revenue and the bottom box being EPS. And as we can see, over the last several quarters, the company's consistently beat expectations by a good margin. And as you can see on the bottom line, the margin of beat is starting to increase.
So you're looking for a history of meet, beat, or miss as far as actual EPS?
Correct. Yeah, I look for the trend of the meet, beat, or miss.
Well, given, for example, that Gigamon has a history of beating expectations, would it stand to reason that if they don't beat them by a large margin in the future, that it would have an adverse effect on the stock? Sometimes when companies underpromise and overdeliver for an extended period of time, then people expect a big beat. And if the company doesn't deliver an exceptionally large beat on earnings per share or revenues or guidance, then it's adversely affected and the price drops. Is that something that you worry about or consider or factor into your analysis?
Very much so. It is a big factor that I look for and a concern that I'm aware of. Understanding the historical patterns of beats versus expectations and the margin at which that company is beating, when as it continues to beat, that becomes the new expectation for buy side investors. And so the first time it misses, you would anticipate the stock to be punished as a result. And so knowing the historical trend will help you, because usually that margin of beat will start to decline prior to an actual miss. And so you just need to be aware that if a company is beat by 5 to 10% over the last 2 years, and now all of a sudden this quarter only beat by 3%, then kind of a red flag goes off in your mind saying, okay, are the analysts catching up to the true growth of this company? or are expectations getting too ahead of themselves? Definitely something you want to be aware of when evaluating a business early on. Yeah, and then another thing just to point out here, what's helpful about this too is that as I look back on Gigamon from in 2014, it was not making a profit the first half of the year. A lot of times for investors that can be an issue per more of the can slim style of investing. You usually tend to stay away from unprofitable business. The fact that it had just turned profitable and now it's been consistently profitable here for 5 quarters adds to that confidence level when you're evaluating this stock.
Well, if you had a stock that had, say, a history of negative EPS and sales, but it was accelerating, say maybe 4 quarters ago it was minus 100% and then minus 75, then minus 50, then minus 25, just for example, is that a stock that you would consider given the fact that you see an acceleration in earnings per share even though it's still negative?
Personally, I would if the top line growth of the business is good, the actual business, I feel confident in that business's operation model, then I will certainly invest in that type of company, even if the earnings at the time are negative. As long as they're trending towards profitability, then I will take a look.
Just for some newer investors who might not be familiar with all the lingo, could you describe the difference between top line and bottom line?
Top line refers to the revenue or sales growth. Revenue is at the top of an income statement, and so that's the top line. Bottom line refers to earnings and earnings growth. So let's dive into it. Based on my initial analysis, I really thought Gigamon could have something, and so not knowing a lot about cybersecurity and Gigamon personally, I then dug into it. And a lot of this information is coming from the company's website, investors relation website. They will have investor presentations, they'll have transcripts from recent conferences they've been at, and you get a lot of information from the quarterly earnings call transcripts that are available on their website as well. And here, a couple snapshots of things that I put into a document for myself so that I can refer to it from time to time as I'm involved with this stock. And so here, realize that Gigamon is a leading network visibility fabric vendor. A lot of its products are network switch-like hardware devices that sit between the production network infrastructure and analysis tools, including application performance. And what that really means is that most companies now have so much information that they're trying to maintain, they have to develop their own data servers. And data servers are these giant grids of computers that is carrying all the information of a business. That's where the hackers are trying to get into. They're trying to access that information. And so companies like Palo Alto Networks will supply a software that is cybersecurity. But in order to make that run very efficiently, the company needs to have good visibility of all the different, call it avenues and streets within the data center that a virus or some sort of cyber threat could hide. And Gigamon's product is the one that allows for that visibility amongst the entire network of the data center that then allows the Palo Alto security software to run to its maximum potential. From that, understanding the product, what is Gigamon actually selling? The main product is what's called a GigaView. It's a software product that enables customers to monitor the database at a critical level and allowing those others. So oftentimes when I first saw this story, I thought, this is probably a competitor to Palo Alto Systems and those type of firms. But in fact, as I learned more, it's actually a partner to those. There is a very finite group of competitors to this. And as you started to read more and more, it became very apparent that this is a very much in need product by major companies. And so you would expect growth to be maintained. Once I have a good understanding of the background of the business, what does it do? How is it selling its products? What are they? I then look for my investment catalysts. So these are going to be a few key drivers of the business growth going forward over the next 1 to 2 years. Here are a few I found at the time on Gigamon. The first one being, I noticed that there's accelerating demand across all geographies and verticals. Gigamon serves not only to enterprise companies, That's like your IBM, your Microsofts. They also serve government and also service providers, your AT&T and Verizons and those type. I noticed that they had a really good year in 2015, and they'd been investing pretty aggressively to continue that momentum in 2016. And I really got this information from going back and reading the past few earnings call transcripts where management talks to these points. And from there, I could see that they had 6 beat and raise quarters. In the commentary of the most recent quarter, management mentioned that they were off to another strong start for the current period. Another catalyst that I noticed was that service provider demand is outpacing enterprise despite exceptionally strong security growth. How I interpreted that was, at the time, service provider revenue was only counting for 20% of total revenues 2015. That segment was growing very strong versus the enterprise, which was the majority of the revenue. And so this mix shift I anticipated would provide that high growth to be sustainable, at least through calendar 2016. Some other things I noticed internationally, it had a lot of room to grow. It grew in Eastern Europe 50% in 2015. APAC, which is your Asia Pacific, had a lot of growth potential. And so not only was it doing well in the United States, it was also selling well into international countries as well. And then here again, strong leadership. It seemed like Gigamon had a pretty good defensible advantage versus competitors. That's driven by its management team, its high quality of leadership, and being able to go out and make good hires on its sales force, and then turning those sales force members into profitable employees for the business and bringing in new business. I noticed here one of the financial releases that they had that they in fact led the industry in time to quote of new sales hires. And so that would show you that hiring more salespeople, then they must be bringing on more business. A couple key catalysts that I definitely pay attention to here that could help fuel future growth. So once we've identified some of the key investment catalysts that we're going to be looking for, the next thing that I go on to is I'm looking for margin momentum. And again, what I mean by margin momentum is the major margins are your gross profit margin and your operating margin. And where are they at now and where are they expected to go? Is the company gaining leverage because they're more efficient at selling the same product and thus they're getting leverage because they're using less expenses to then sell more product? Are they requiring less labor? And so that would lead to operating margin. And here I noticed that for Gigamon, that even though they were focused on an international build, they were really expanding the domestic sales force, and it was looking like management alluded that it was getting to a critical point that by 2016 they would be able to sort of turn off that hiring spend and start to leverage those new employees that they've hired, and that would produce margin leverage in late 2016 and in 2017. Also looking at sort of the street forecasts, given the trends of beats that I noticed and the growth that the company was exhibiting at the time, it seemed like the street was modeling a 25% growth rate for 2016 and 18% growth rate for 2017. Those rates seemed a little low given the recent growth of the business and commentary from management. That led me to anticipate that maybe analysts were giving it a lower margin than what the company would actually end up doing. Management on the fourth quarter 2015 earnings call actually commented on the fact that they were seeing considerable leverage in their model and that they guided to a long-term target of 23 to 28% operating margins, which was well above the street's forecast at the time of 19.6. That just strengthens my conviction that there could be upside, and that's very useful when I'm creating my financial models. To wrap things up, when I'm doing my initial research, like I mentioned before, competition is something to definitely be aware of. Here, I was able to determine that its biggest competitors are Ethernet switch vendors like Cisco, Brocade Communications, and Arista Networks. And then also it competed against network management, sort of security tool vendors, but those are mostly small private, more of a fragmented business. But still need to be aware that while Gigamon does seem to have a pretty decisive lead over pure play competitors, it is very easy for someone to come in and to start gaining market share, as Gigamon at 25% market share is the largest, but certainly could end up ceding some of that to a new competitor. Always need to be aware of is what are the current risks to the company. And Gigamon is heavily reliant on their technological advantage and their lead versus competitors. And so if there was a change in that technology, that could adversely affect Gigamon. Also, global macro concerns. A lot of the expected growth is coming from international markets. And so if we thought there was going to be a change globally, so maybe we thought currencies were going to heavily impact foreign countries, making Gigamon's product more expensive, then they might be less likely to want to buy Gigamon's product. That would be a negative. Understanding just some of the broader buckets of concerns, dynamics to be aware of, certainly is sort of how I round out my research.
Well, would you say that you try to focus on the leaders in each industry group, or are you more concerned with focusing on what stock has the most growth in that industry group?
Both. I'm always trying to find the best growth company within a industry, but oftentimes you get better upside or just as good of an investment from the number 2 and number 3 players.
Probably especially if they're gaining market share too.
Exactly. If a firm is gaining market share, then that's definitely something to be aware of, because they could become that leader in the industry in a few short years.
Yeah, sometimes the leader grows lazy and complacent while the number 2 and number 3 are still hungry to be number 1.
Exactly, and you do see that a lot. Now that I feel very comfortable with the overall firm, understanding the catalyst, the dynamics, threats, concerns, the last piece of the puzzle, and one of the more important pieces, is valuation. You hear this a lot, and it's very true. Valuation at the core of it is quite subjective. What one person think is a good value may not be for another person. And so what you're trying to do is, instead of trying to pick a specific number, you try to identify a range that seems appropriate for a given company. And using that, I find, is more helpful, because at the end of the day, this is probably the most subjective part of fundamental analysis, is determining a fair value for a given company. The best way that I go about determining a fair range for a business is by running a comparable analysis on public peers. So here I'm showing you a table with Gigamon in addition to Palo Alto Networks, Broadsoft, Fortinet, Ruckus Wireless. These are all enterprise software suppliers or hardware suppliers. And from here, we can get a good idea of where is sort of the general range for this industry, and then looking at the relative valuation versus the peer group for Gigamon. So we could see here, I've circled in red, the price to earnings is considered to be the gold standard in terms of valuation for these type of businesses. Looking at the price earnings, the left column, you'll see NTM, and that refers to next 12 months, at which time back in April, Gigamon was trading at 28.3 times versus a peer group average of 34.3 times, trading at a pretty good discount to the group at the time. And then as we project out even further, 2017, again, Gigamon at 23 times versus a peer group average of 27. Right now, the market, for whatever reason, is pricing in, or is telling you that they believe Gigamon should trade at a discount. Usually, if it trades at a discount, it's because it's not growing as well as the rest of the peer group. It's losing market share to competitors, or there's some sort of flaw in it. I didn't see that with Gigamon, and so this is what really sealed the deal for me, is that I thought there was a big discrepancy between the value it was being given at the time and what its true value was. I just sort of summarize it for myself by saying Gigamon, it's undervalued because as I look at the growth rates of its peers, Gigamon is showing better growth, it's expanding its margins, and it seems like it has a lot of opportunity for further penetration both in the US and internationally. And those sort of core investment thesis points really led me to believe that this stock is being undervalued. And I assume that Gigamon is going to continue to grow its revenue and earnings above 20% for the next 2 years. And based on that, 30 times is a relatively fair multiple, as it would still put it at a slight discount to the peer group. Now, as I mentioned, I do create financial models for my projections. From my financial model, I was able to calculate a EPS number for 2017, of which I got $1.24. Applying 30 times to that gave me a 12-month price target of $37. At that time, I saw a good entry in the stock around $28, and that would give me an upside target of 32% return. Here's just a screenshot, and this is my financial model. You're looking at the income statement, and I recreate it, and then based on the historical information, I then forecast going forward. Now, this financial model right here has been updated for when I exited the position. You'll notice that for 2017, my diluted non-GAAP EPS, which was $1.65, is much higher than the original $1.24 that I was forecasting. And that's one thing you'll come to realize with fundamental analysis, is that it's a moving target. Fundamentals change every day, and you have to stay updated on what is going on with the fundamentals and how new information or new events that occur for a business, understanding how they're going to affect the business and using that understanding to then adjust your model is crucial to my process. Here, also showing you, not only do I recreate the income statement, but I also try to drive to the best way I can the revenue generation, because revenue is sort of the key to the income statement. And so here's just a screenshot. The company doesn't give you a whole lot of details about how they make their money. This is just breaking it up into reported business segments that they identify and applying simple growth rates to it per commentary from earnings call transcripts, articles, company presentations at conferences, what I believe that they should be able to grow for that. This gives me a revenue number that then plugs into the prior income statement, and then from there I determine what the margins will end up looking like, and then applying all the expenses, which gets me to my earnings per share. So I entered this trade back April, and at the time I thought my initial price target was $37. But after getting into the position and as I went through a couple earnings calls, my trade plan continued to evolve. So once I've created my financial model and I've been able to use my revenue analysis to then help drive the income statement, applying the appropriate expenses, I'm able to get to my earnings per share number for 2017. Once I have that number, I then go back to my comparable analysis and using again the appropriate range that I've determined, and based on Gigamon's accelerating fundamental growth, the peer average for the forward PE multiple, I really felt a range of 30 to 35 times. Applying that to the fiscal 2017 EPS that I had modeled and forecasted was a reasonable valuation. Just to recap, 30 times $1.24 gets me a $37 price target. And so that's sort of the circle in which I'm able to come to my price target.
When you talk about your models, I can't help but to think, how would an average investor go about creating some kind of a basic estimate or projection for EPS and revenue and margin and things like that as they try to perhaps recreate your process?
I don't expect most of your listeners to go to the extent to try and learn how to create financial models for themselves. But on a very simple level, using the company reports that they already provide on their investor relations sites, you already know know what the growth rate has been for the last few historical periods. If you just simply took the revenue that the company did for the last 8 quarters and calculate the year-over-year growth, you could then use that to then anticipate, in addition to understanding and going back through earnings call transcripts, you could, with some degree, try and estimate what you think the growth of the business will be going forward. And basically, you're doing it on an annual basis. So you take 2015's revenue, which was $222 million, and you say, you know what, in 2015, the revenue grew 41%. The prior year, it only grew 12%, but they've made a lot of investments. They have these new products in the marketplace. I think that growth will continue to be similar to what it is in 2015. So you could just project a 44% growth on that 2015 number. And so all you'd have to do is take 222 times 1 point in whatever your growth rate is. So if you applied 40%, you times 222 by 1.4, and that would produce your expected revenue for 2016. You could do the same thing on an EPS basis. So you really could leave out the middle part of the P&L and really just focus on revenue growth, what it's done in the last few periods, projecting that forward, and then what has EPS done the last few periods and projecting that forward based on your understanding of the business and commentary from management. You could get to a rough estimate for earnings. I really do the last 8 quarters, and I just look at what the year-over-year growth for each of those quarters was and try and identify a trend. Is the growth going sideways? Is the growth increasing? Is the growth decreasing? And from 2 years of historical information, you can usually determine where that trend is going, at least for the next 4 quarters going forward, so the next year going forward.
What about, say, comparing the 5-year, the 3-year, and the 1-year growth year over year to each other? If you see an acceleration in that, would that indicate to you that this is a strong company and might be worth being put on the radar?
Very much so, yeah. If you saw accelerating growth as you moved forward in time from the 5-year to 3 to 1, then yeah, that would tell you that there's been a change in the business model and, the fundamentals are getting stronger, which is at the core what you want to see.
And what about the traditional Bill O'Neill looking for the 3 quarters of accelerated growth or the 3 quarters of accelerated revenues?
I like to consider that more icing on the cake. In a perfect situation, that's exactly what you want to see is 2 to 3 quarters of accelerating growth. But a lot of older businesses that have been around for a while, they are not likely to have those growth dynamics. And when I do see it, gives me more conviction behind the strength of the company.
A lot of people don't have the in-depth tools that you have, but for example, MarketSmith, a lot of growth traders use MarketSmith because it's pretty convenient for looking at charts and getting some fundamental data. But as you look at the actual EPS from the last couple of years, and then you look at the estimated EPS in the year to come, do you give the estimate for the next year much weight?
I do. I do give it a good amount of weight. At the end of the day, that number is created by a group of analysts that are paid to follow these businesses. So they have some very high level understanding of the current business dynamics. Now, having said that, they are doing a job where they're trying to increase a firm's trade activities. Like most things in life, the content always has some sort of bias. I do understand that there's room of error within those estimates. It could either be too low or it could be too high. And that's where I feel like my advantage is because I can go in and try and understand where that difference is and how big the difference could be.
What about comparing the current quarter EPS to the 3, 5, or 1-year growth rate? Say you have a current quarter EPS that's 25%, which is much higher, say, than the 1, 3, or 5-year. Would that be a stock that might catch your eye for further investigation?
Yes, it definitely would be. The first thing that I would want to know is why is it spiking? Is this a one-time event? Did something happen in the most recent quarter that is not likely to repeat itself? Or is there, in fact, a change to the business? They released a new product, they're providing a new service, they gained market share that's going to be a lasting driver of future growth.
Would you say that it's more significant to see the current quarter EPS sales or the margins larger than a year over year, say the 1, 3, 5 year versus just another quarter?
But you definitely want to see the most recent quarter being as strong as possible, especially relative to those prior periods that you mentioned. The stronger it is relative to the past, the more confidence you should have in the business's growth potential moving forward. As I got into Gigamon here in April, I really thought that there was about a 30% upside to a $37 price target. But I knew that depending on how the company continued to perform, there could be some upside to my price target as time went on. And here is sort of an update of the trade plan as I was involved with this name. And when I got involved, it was right around when it reported its first quarter 2016 results. And as we can see here, growth reaccelerated from the fourth quarter of 2015, which was not being anticipated by analysts at the time. And so as we could see between the first quarter of 2016 and the third quarter in the top red square, this outperformance spurred my estimates to go up. Here over the last 3 quarters on a revenue basis, the company has outperformed by 8%, 7%, 5%, which is slightly above what it had done the prior 3 quarters. When you're thinking about, how big are the beats, and is that gap getting bigger or smaller or maintaining? Here, certainly those beats are maintaining. And so that continued to give me confidence that the estimates by the analysts were too low and too conservative. Margins of beats continue to remain pretty high. You can see the same thing on the EPS line, which is the second red box. And again, these were massive beats. It beat by 21%, 25%, 18%. Over 4 quarters can add up to be quite the difference between what analysts expected and what the company actually reported. Here again are the analyst estimates from April 2006. You could see they originally thought going into the 2016 that 2017 EPS was going to be $1.24. Now, by the time I was getting ready to exit my position in the month I exited in October of this year, so 7 months later, $1.24 estimate had risen all the way to $1.55, showing you the power of performance by the company and the fact that analysts were, for whatever reason, were not understanding the full potential of that business. That's where the opportunity creates itself for investors like us. As that estimate went up, my estimate went up as well. As I adjusted my models over the last few quarters, I ultimately found myself at a $1.65 projection for fiscal 2017 EPS. My range of multiples that I determined to be fair, I kept the same, 30 to 35, but because of the strong outperformance, and then not only on an absolute basis, but also relative to the peers, I determined that it's probably the higher end of that range is more appropriate than the lower end of that range. And the 30 to 35 times $1.65, I was looking for an exit price somewhere between 50 and 58. But given that outperformance, I was looking more 55 to 58 as my exit. Thinking about where it had been since I had been involved back in April, went from $30 to $55 here in October. It's quite a large move in a short period of time. Given where my estimates currently were sitting, it became apparent that at this point, a lot of that future growth had now been priced into the stock. There was a lot of positive sentiment around that stock. And usually at that point, that's when I look to make my exit as it triggers my price target based on the estimates.
And it sounds like it's triggered right about the time the trade starts to get really crowded.
Right. By this time, now that it's outperformed for several quarters, other investors are aware of the trade. And as we've seen time and time again in the past, once everyone starts to pile in, and eventually there's not a lot of people left to buy.
I'm looking at a chart right now. I should probably share it with everybody. It actually hit 56 and then 61. 61.25. So that was a really very accurate estimate on your part.
This one definitely lined up very well. I believe my official exit was somewhere mid-October around 36. There's no one way to best approach this, but I feel that applying my fundamental process alongside my understanding of the technical analysis, the can slim system, really gives me two very sharp spears that I could use when trying to hunt these stocks.
Do you ever feel like by having a target, you actually shortchange yourself on potential profit?
Yes and no. By having a target, you can become more focused on the price target opposed to what the stock is actually doing. Valuation on a fundamental basis is quite subjective. And so while I might have thought the peak valuation for Gigamon was 35 times the next year EPS, in fact, the market actually might have determined that it was 40 times that. I use my price target as a goalpost, not an end-all be-all line in the sand. If the stock doesn't perform and it's not even near my price target, but it trips a sell rule like breaks below the 50-day moving average on heavy volume, I'm not going to wait around for my price target to get hit if it's showing signs of weakness. I will exit before I get anywhere near a price target, or in fact, if I miss some of the upside going forward, then as long as I locked in a decent profit, I think on this trade going from 30 to 56, locked me in an 86% profit. I'll take that all day long, even though I didn't pin the top at 61. I'm more than okay leaving a little bit room. You want to make sure that there are people who still want to buy the stock when you sell.
Right, selling into strength. Just hypothetically, if you will get out of a stock that's not performing well and doesn't look like it's going to meet your estimate, by the same token, would you also let a stock continue to run higher if it was showing signs of strength?
Yes, I would. While a lot of our conversation today is about the fundamental process, I do want your listeners to know that I do have a list of buy and sell rules that I do use that are based more on technicals than the fundamentals. I overlap the two. It provides me a pretty thorough system that I can trade. For the most part, though, based on that fundamental process that I run, I tend to be a little more lenient in the stock. A lot of my strategies revolve around where the stock is relative to the 50-day moving average. In some cases, it's a really strong trend. And in fact, the 20-day moving average is the boss average. I'll usually use something along those lines as my line in the sand and trigger for warning signs.
Well, if you have a really great candidate, you've run it through the mill and you've decided it's undervalued and it's got a good price target and you'd like to get into it because it has strong fundamentals, it has good drivers, good catalysts, able to sustain solid EPS and sales growth, how would you go about getting into it? Would you just buy it right there on the spot, or would you wait for it to set up in a proper base or horizontal consolidation or pull back to a moving average?
I will try to wait for the stock to show me a pattern and then using that pattern to identify buy areas that will result in very low risk points. With that said, if I've missed the initial breakout, so say there was a long period of sideways consolidation and it had recently broken out and say it's about 5 to 10% above that breakout point, if my fundamental process determines that there's still 30% upside in the stock, then I will still buy that.
So as long as you feel that you can control your risk properly, you'll get into the stock even if you've missed a pivot in a base, as long as the reward is still good.
Right. When and if I can, I do try to look for, on a conservative level, a proper breakout from a proper base. If I really have strong conviction on the fundamentals, then I will try to enact more aggressive buying rules using trend lines, using shakeout +3 patterns for double bottoms, or looking for pullbacks to a moving average as a good area for initial buys.
Well, what would be the maximum amount of risk that you would allow for a stock that is on your fundamental candidate list? What kind of drawdown would you allow on that?
5 to 8% for me is about the maximum risk. And again, that's predicated on buying from areas of good support. So areas that should provide a low risk entry. Personally, I try to minimize risk as best as possible, but given that I'm usually more long-term time horizon, I do like to give my stocks a little more room. So I usually give my positions about 7 or 8% from my buy point, and that's based on the fact that I'm buying the stock right. I'm buying off a breakout point. I'm buying off a retest of a moving average that should provide me a low risk entry. I should not see my stock come down to that 7 or 8% loss and trip me out.
And if it looks like you're in a situation where it would need to be higher, you just adjust your position size down to compensate?
Yes, always managing my risk. I have, for my own portfolio, determined the amount of total capital I'm willing to risk on every trade. For hypothetical purposes, say it's a $20,000 account and I'm willing to risk 2% on every single trade, then I'm only willing to risk at most $400 on that trade, depending on where I buy versus where I feel is a logical stop area, whatever that spread is. So say if it's $1, then I can buy 400 shares. If it's $2, then I can only buy 200 shares. And so I also try to manage my risk that way as well.
You know, there is one question that I meant to ask you earlier. A lot of retail traders don't necessarily have access to a lot of margin information, especially prior quarters. Some of them like to use ROE, return on equity. What are your thoughts on ROE versus margins?
Both are helpful for those who don't have access to or don't want to spend the time to calculate the margins. There are ways that companies can manipulate the ROE depending on what their capital structure and how they're funding their business. So if they load up on debt, then it can make the equity look very good and vice versa. And while most companies, it's a very good metric, I do prefer actual margins because those are directly related to the company's operations. And that's ultimately what you're investing in.
Well, if a retail trader is only able to use return on equity, are there some ways to spot that manipulation?
Compare that row with the debt levels as a sort of a main balance and checks for that metric.
What about cash flow?
I want to see, is the cash increasing, decreasing? Where is that cash coming from? Are the actual operations of the business funding that increase in cash? Or are they only increasing cash because they're financing or doing investment activities that are non-core to the actual business operations?
What are your thoughts on having cash flow be at least equal to or greater to the current annual EPS estimate? 2016 was $1.26 and cash flow was $1.01. Do you feel that there's any correlation between a strong cash flow and the EPS estimate for the current year?
There certainly is a strong correlation. You want to try and see that cash flow number as close to the projection, if not greater than the projection, showing you that there is enough liquidity in the business to continue to fund and produce future growth.
How low of a cash flow would you accept relative to the current EPS estimate for the year?
I try to look for cash flow that's at least within 20% of the estimate or greater.
I actually wish that we had some more people here to ask you even more questions, because I'm sure after they watch the show, they're going to have so many follow-up questions that they would love to ask.
I'm always open to speaking with anyone who's interested. I know I didn't mention this in my intro, but I am a IBD meetup leader in Orange County, California for the Huntington Beach group. Always open to have new members join or have some conversation on the message boards.
And you're an organizer there, so they can contact you by going to the member section and finding the leadership and then sending you an email, right?
Yes, exactly.
Most traders, when they have a trade, after it's all done, they'll do a post-analysis to figure out what they did well and what they did wrong, and compare what they expected to what actually happened. Do you do any kind of a post-analysis with your fundamental analysis after the trade?
Yes, I do actually. Most times after I've exited a position, I require myself to maintain my model forecasts for the next 2 quarters going forward. That way, I can determine how accurate I was in modeling while involved with the stock. And also, I keep track of the stock another quarter or so to determine to see where, in fact, price has gone, determining whether or not I had a good range in terms of a fair multiple range that I was using to determine my price target.
What would be one or two things that you've noticed over time were at the root of a price target not being met or having your model actually play out as you anticipate?
A major factor that causes the price target not to be hit would be some exogenous event that was unpredicted. The company lost a key customer, there was a recall on something, like those obviously would impact the stock, or say there was some sort of lawsuit. Those would definitely hurt the stock and probably cause it not to reach the price target. Another thing could be just sector rotation. So if you're investing in an industry that's cyclical, it might start to get rotated out. A recent example would be Facebook. Tech through the last 18 months has been a great bellwether, but now as other sectors like infrastructure, financials are where the sentiment is going, that money has to come from someplace, and so it's being rotated out of places like Facebook. There are events like that could also cause price targets not to be met. Usually when a price target's not met, it's more on a miscalculation of the fundamentals. I expected that the company was going to grow at certain rates, but as you come to find out over the next quarter or a few quarters, if dynamics change in the industry and the commentary around that growth starts to become less than what it was, then you're going to see a change in sentiment and those estimates will come down, contracting the price target.
Have you noticed any trends when your models play out perfectly and hit the target? Have you noticed one or two things that they have in common?
One main common factor is accelerating growth. From when I start looking at a business to what it actually ends up being over the next few quarters, if that growth is better than what was originally anticipated, that usually leads to a strong growth appreciation. Another factor is also really understanding the competitors, the dynamic market share, and being realistic about where the company sits amongst its competitors and how it should be valued on a relative basis.
So would you say when you're trying to establish that value that you try to avoid the upper end and maybe go for the lower end to the middle end of estimated value?
Yeah, that's why I never try to hold myself to a specific multiple number, because I feel that can make you too subjective when evaluating a stock. By forcing yourself to use a range, you're capturing not only the upside potential of a fair multiple, but also incorporating the downside. It gives you flexibility to be more objective from a execution standpoint.
Have you found that your models work best in a new bull market as opposed to a late bull market?
The models itself work well in any market. It's more the type of companies you're trying to model. So obviously early in a bull market, growth stocks are doing very well, and so you most likely would be modeling those. Later in a bull market, you could still be looking for growth companies, but that's where you have to be more conscious about valuation in terms of just understanding that later in a bull market, you're not likely to see the high valuations that you saw in the early stages of the bull market, and understanding those dynamics.
So you will factor that into your fundamental analysis, not just what sector's hot, but also what industry group or sector thrives at this particular stage in this particular bull or bear market.
Yeah, very much so. And I do like to incorporate IBD's industry groups over the last 1 month, 3 months, 6 months. What are the leading groups? Where the high valuations being warranted, and where have valuations come back?
So this is a little bit off the beaten path from fundamental analysis, but You are a trader, and fundamental analysis that you do is a lot of work. You put in a lot more time and effort than the average investor. So I was wondering, is there anything that you do to deal with stress to make sure that you have a healthy and balanced life?
Yeah, definitely. I think most important for any trader, no matter what your style, is mental psychology and balance. It's very easy in this industry to get consumed with your work and drive you deeper down the rabbit hole. Having that balance is crucial. For me, where I find my balance is I'm an avid workout guy. So I love to go to the gym almost every day if I can, whether it's lifting weights or doing some sort of cardio activity. I just like to be active on a daily basis.
There's probably a lot of traders out there who listen to us talk, and they probably are thinking, hey, I would really like to learn more about fundamental analysis and how to do it, and to kind of continue where we're leaving off. So I was wondering, what would you consider to be the 2 or 3 best or most helpful or most important books that you've read regarding fundamental analysis for those who want to learn more about it? If no specific books come to mind, then as you look back on the process that you went through as you developed your skills in fundamental analysis, can you point anyone in the right direction?
A decent amount of my initial fundamental understanding came from How to Make Money in Stocks by Bill O'Neill. It touches on it, and it's not solely focused on that. There are fundamental analysis is intertwined throughout the entire CANSLIM system. Learning more, going on investors.com, using their different products will provide you a decent level of fundamental analysis. Where I would point people to also look is find some books or any publications on investors like Warren Buffett. Look for guys that are considered value investors. Value investors are usually driven by fundamental processes themselves. And there's a lot of investors out there like Warren Buffett that you can find some information on how they go about trading and what their process is like.
Peter Lynch also comes to mind.
Yeah, he's another one. Invest in what you know, very much fundamentally driven.
Who are a couple of your favorite traders, or do you have any?
Yeah, there is this one. She's quite the famous trader up in Tacoma, Washington.
Oh, no, you didn't.
I would have to say I'm a big fan of you, Heather. You're one of my favorite traders.
Oh, Jarrid. You're too kind.
Outside of that, I admire, like I mentioned earlier, Warren Buffett. Ray Dalio is another great investor. And of course, Bill O'Neill. I spend a lot of time looking for books to read up on and really like the systems that they've been able to master.
What would you say have been some of the most important lessons you've learned as a trader who uses fundamental analysis that has personally helped you improve your trading?
The main thing is creating a process, testing that process, and sticking to the process. If you've developed a process and it's a successful one, and it produces positive outcomes, then you have to be disciplined to stick with that process, because there are going to be times where it doesn't look like the process is working and you think, oh, if I do this differently, I'm going to get a positive outcome, when if you just stuck with the process, ultimately you would have gotten to a positive outcome. Big thing that I've learned is once you have a process that you've proven to be successful, just sticking to that is key. Also, having a short memory. The market changes every day. There's new information on businesses every day. And so you have to be able to take in that new information without holding on to the old information that might be conflicting. You have to then take that new information. How does it affect the old information, and make the appropriate changes is another crucial part of my process.
What 2 or 3 pieces of advice would you give to traders who want to improve?
Learn how to understand the main financial statements. If you can understand the income statement, the balance sheet, and the statement of cash flows, and what the key metrics for each of those statements is, it will exponentially enhance your ability to evaluate the strength of a business. Another point of advice, spending the time to learn the story. Don't just stick to the technicals. If you want to really enhance your fundamental abilities, start going on company investor websites. Go look through presentations, read earning call transcripts, find any article you can on the business and really have a good understanding of what the business actually does.
That's very good advice. Before we go, are there any stocks that have caught your eye that you might want to run through the fundamental analysis mill?
Big sector that I'm tracking are the semiconductors. A lot of them, while being tied to the smartphone markets, tend to remain at pretty good growth rates, yet valuations have come in. Companies like Avago or Cirrus Logic, CRUS, two companies that are on my watch list, as the fundamentals are showing some good strength. Valuations have come in and looks like there could be some opportunity. Additionally, been tracking some of the Chinese companies. Weeblo, WB for Weeblo. A lot of the Chinese companies have very, very strong growth, yet depending on macro factors, sometimes the valuation can be hard to pinpoint. Also, still looking heavily at home builders. There's a lot of changing dynamics. Interest rates are going up, which are driving up mortgage rates. So I'm really looking at some of the home builders that are more focused on the entry level type homes. I would anticipate that there could be a nice runway for those businesses over the next year or two. So those are three main industries that I'm really focusing on right now.
Well, Jarrid, it has been so fun having you on the show. I didn't think it would ever happen because of your hectic schedule and a heavy workload, but I'm really glad we were able to connect and go over fundamentals.
Thank you so much for having me. Glad I could share my story, my process.
Well, I really appreciate you taking the time to share your experience with everyone in the chat room and all the new traders and experienced traders alike, because you're very good at what you do. You've got a lot of experience and a lot of knowledge, and there aren't a lot of traders that I know that have as much experience with fundamental analysis as you do. So I really appreciate you coming on the show.
Very honored. Thank you again so much for having me.
Well, it's been a lot of fun, and I guess we'll see you in the chat room.
Definitely.
All right. Thanks, Jarrid.
Thanks, Heather.
A very special thanks to our guests for being on our show. It's been a lot of fun. Learn more about trading at Tacoma IBD Meetup Group, where it's always free and it's always about becoming better traders. Thanks for joining us on Stock Talk Happy Hour. Good fills, everyone.